Hi everyone, my name is PK and here I have Monica Revelis here. She is a solicitor, and in this episode we'll be talking about entity structures. Honestly speaking, if you get this right, then that's a long way towards your property investment strategy and property investment goals. We'll be talking about personal name versus corporate entities. We'll be talking about types of corporate entities for buying investment properties. We'll talk about the considerations of buying in different entities like land tax, CGT or capital gains tax. We'll talk about negative gearing. Does it give you benefit in different entities like companies, trusts, etc.? And the pros and cons of setting up a trust. There's costs involved, there's deeds, there's documents, etc., etc. But we're very fortunate to have Monica on because, like I said, she is a solicitor at Sound Counsel. That's where she works. She's also a muso and she's also a lecturer, I believe. So very accomplished woman, very all-rounded person, and also a property investor. So who better to have on? And thank you so much, Monica, for making time for us.
Pleasure to be here, PK. Thank you for having me.
All right, well, maybe we'll just start from the start, like just a bit of an introduction for you. Like, what's your sort of journey been like from an investment or property investment perspective?
Yeah, so I bought my first property, I think, when I was 28 years of age. I bought that in my personal name with my brother,
Hmm.
in regional New South Wales. And at the time, I went with my brother because he helped me service the loan better on what was basically a $350,000 property at the time. So I had the deposit saved up. Well, we actually went in 50-50 with a deposit, but I had additional cash for renovations. So we bought this house in mind with the idea to renovate that, to increase the equity and increase the rent on the property, which we did. So I think we renovated for no more than 25,000. It was basically a paint job, new kitchen, um, restained the hardwood floors just to give it a bit more of a modern look, and that increased the value by about $60,000. So we were quite happy with that. And the rent, originally we were told we could rent it out for 350. After the renovations, we were able to rent it out for 450 per week. So it's amazing what a cosmetic reno can do in that regards. And then I bought my second property a couple years later. This one was actually a unit, also in regional New South Wales, but in a very small complex, which has had since considerable growth, but also the rental yield was phenomenal. So it outweighed the risk. But again, with that particular property, the reason why I went with a unit, which is something I generally don't do, was because in this particular town, there aren't many units and not many one bedroom homes. So I saw that there was a scarcity. I also was aware that there was going to be a lot of developments happening in the town in terms of roads and other infrastructure, which meant that my place would be in high demand and still is. So that's what I went and did. Now, at that point, I wanted to go for property number three. And I learned, whoops, the banks aren't going to service me, even though both my properties were positively geared and cash flowed. And that struck me as odd, but particularly with tier one banks, they do shade down that income. And this wasn't when interest rates were at, 2%. The interest rates were at 5% at this time. And I was still being told, no, I couldn't service, which was strange because I had a very strong income by this point in time for a single person, and my properties were producing me income, which they weren't factoring in. So I then looked at other ways to restructure my portfolio based on the stuff that I was given advice to clients when I was working for a Big Four tax accounting firm. And I realized that, there are some benefits to restructuring and taking out all the debt in my name. And basically, that's what I did. I restructured the portfolio. And from there on, I haven't exactly, oh, sorry, I went on to buy property number three, um, which was now about a year and a bit ago. And I'm now in a position where I can literally keep buying properties endlessly as long as I have the deposits. So that's kind of where I'm at now. I'm looking to maybe buy another three or four in the next 12 months.
Oh, wow, amazing. I didn't know that. Well, good for you. Some of the best lessons are the hardest learned.
And the
Hopefully
expensive
we can,
ones as well.
yeah, exactly. Hopefully we can sort of all make the most of your experiences and learnings. And I just want to ask this question as well, because people will be like, oh, why do we have a solicitor or a lawyer talking about entity structures and trusts and companies? Like, should an accountant be talking about that? So could you just elucidate, what the place is for a tax lawyer or a solicitor in this realm?
Yeah, so accountants are good from an accounting point of view. So, running numbers and understanding the structures in terms of a perhaps tax accounting point of view, that's what they're really good at. What solicitors do, and this is actually something that accountants can't actually do, is draft the documents that are needed to form those companies and trusts. And this is probably more important, not so much in the sake of a company, especially when we invest. A lot of my clients tend to be individuals or husband and wives. So, documentation is somewhat irrelevant in that case. However, the trust documents are actually very, very important to have them properly drafted by a solicitor because down the track, particularly when you're trying to move the asset, say you want to transfer it intergenerationally through your family, that's when it can be problematic. I even had one client who did a do it your own trust deed. I think it was a law path trust deed that they had a go at. And the actual powers to purchase property was missing from the trust deed. And then it was a costly exercise because we basically had to do the deed. We had to vary the trust deed. And it was a lot of work to get it to where it needed to be in order to not only be able to borrow in the property, but also to ensure the client's wishes down the track would be met. So, and that's the other thing I think a lot of people forget is that trust isn't a structure per se. It's actually a contract between what we call a trustee and the beneficiaries. So the trustee is the person who manages the trust, similar to like a director in a company, and the beneficiaries are the people who are going to benefit from the profits and the distributions from that trust at the end of the day. So having a document that is worded is very, very important.
Right.
And as well as that, I think also getting that advice on, often I get clients saying, oh, yeah, I want to buy a property in trust, but I also want it for asset protection um, because their accountant says they might have that benefit. It again depends, who is your trustee, who's your beneficiary, and who's your appointer in order to actually have that asset protection at the end of the day.
Right, right. I think this will be news to a lot of people, or hopefully it's beneficial, but I can definitely resonate with that. I'm actually going through a restructuring exercise of our sort of family holdings, you could say, at the moment. And we have a brilliant accountant, but he's sort of employed or he's working with a completely different solicitor or legal professional, tax lawyer, as we call him, to actually refashion a lot of these, trust deeds and all this sort of thing. And yeah, it's a completely different skill set. So if anyone's out there sort of wondering, maybe we should get an accountant to talk about this. Yeah, we should always get accountant advice, but I think it's very relevant and pertinent to have a solicitor's advice on this because they're actually the ones in the legalese. And of course, I should also say none of what we're about to talk about is financial advice or legal advice or anything of that matter. It's information and it's general in its nature. But let's start with the first point. So personal name versus, these corporate entities. We're using the word entities a bit loosely, like you mentioned, because a trust isn't really an entity. But for someone who's new to property investing, they're like, oh, it's just so much easier just to buy under my own name or wife's name or 50-50. Um, I guess, how should we think about this?
Yeah, I mean, look, there's nothing wrong with purchasing under your personal name. It's just you have to be aware that there are some limits that you're going to hit. So if you are looking to rely on your investment portfolio as a passive income stream that can then replace your active income streams at a later point in time, then perhaps buying property in your personal name isn't the best option for hitting that goal. So some of the issues with buying property in your personal name really is around the debt that is attached to you as a person. So I like to kind of view debt as like a beaker of water, right? And every time you take out a loan, whether it's a house loan, a credit card loan, or a car loan, that beaker gets filled with water. And the only way you're going to get rid of that water is by paying down that debt or pouring that water into a bigger beaker because your income has gone up. So once you hit that particular point, that's it. You can't borrow any further. But also in your personal name, there's a lot of risk attached to it. Particularly for business owners. If you are like a professional like myself, a solicitor, real estate agent, even, and you have assets in your personal name, they are very much exposed to litigation if someone were to sue you for some particular reason. So there are those particular hurdles there. And then the other issue you often have is that you're limited with in terms of who you can actually pass the property onto, other than through a will or intestacy. Generally speaking, like you're limited in terms of who you can pass that property onto without that other person then having to pay stamp duty and CGT on their estate. So um, there are some important considerations there. I guess the other issue to also think about the tax implications as well. So in terms of the tax implications of owning property in your own name, if you become a high income earner, and of course this is going to change from the 1st of July with the stage 3 tax rates, but as soon as you go into that top marginal bracket, the income that you're going to produce from your property, whether it is income from rent or from capital gains when you sell your property, is going to be taxed at that higher tax bracket, which for a lot of people to lose 46 cents in a dollar of your rental income, so that's nearly half when you factor in the Medicare levy, is a lot of money to part with, right? And likewise, even with selling property in your personal name, yes, you get the main residence tax, main residence tax if it's your own main residence, but you also get the CGT exemption for investments property, which basically means you only pay tax on 50% of that income. But, 46, 48% of, 50% is effectively a quarter of that income that is going to go to the ATO. And that's a lot of money to part with when we're talking about, gains of, upwards of hundreds of thousands of dollars or even millions of dollars at the end of the day. And from a tax planning point of view, there are just better ways to structure your portfolio so that you can also minimize tax. So
Right.
this is where corporate entities come in. So basically, a company is what we call an artificial person. It has the same rights, both legal and contractual rights, as an individual. But instead of just now having me as a person who buys property, I can effectively like clone myself in a company, and now that company can buy property. And this is quite important because now you have another fictitious person that can buy property. And if you have multiple properties, ideally you will try and set it up in multiple structures. And there's a couple benefits in doing this, or using companies as a structure to begin with. So first of all, in Australia, companies have what's called basically this um, limited liability principle. And so what that means is that as a shareholder of a company, if you have fully paid for your shares, you are no longer liable or owe any money to the company, other than if you want to inject more capital to buy or to purchase more assets or, but apart from that, like you are not liable to the company. And then we also have directors who manage the company. Now, the directors are governed by what we call directors' duties, and they're basically fiduciary duties owed to the company to ensure that the company is managed responsibly. And these two principles basically isolate the risk in an entity. So, for instance, if you own property in your own name, anyone can attack that, who tries to come after you can attack that property. In a company, the only way people can really come after the assets of the company is if the company have, or the directors of the company have breached those directors' duties, right? And this becomes important, particularly where, for instance, a company doesn't perform well or is unable to pay back its debts. If the directors have done everything possible to ensure that the company could pay off its debts, but it still can't, we now have the corporation's framework that allows creditors to step in and actually restructure the company. We don't have that in our personal name. The only option really is bankruptcy, which
Right.
is not necessarily a pleasant option for most people. Although in Australia it's treated as a recovery process, you know, and I have seen clients that are bankrupt and still making $500,000 a year. It doesn't stop you earning, but it does limit in terms of whether or not you can own property. So, having the corporations framework is just that extra layer of protection, given that provided that you meet the requirements to have that protection. Um, the other thing that is really effective for companies is the tax planning purposes. So companies in Australia, and I'm just going to talk about this generally, because with property, it's a little bit different in terms of how they treat companies. But generally speaking, the company has a 30 cents to a dollar tax rate. So if you are already a high income earner, and even from the July 1 tax cuts, as soon as you're earning more than $45,000, it becomes effective to have a company. And from a property purchasing point of view, what's really useful about owning property in a company is that all the profits are now going to be taxed at 30 cents to a dollar, not your marginal tax rate.
Right.
The only time it will be taxed at your marginal tax rate is when you distribute to the shareholders. But then again, there are also other things we can do with those shareholders, such as using trusts for the shareholders for better tax planning purposes, and to achieve similar effects to what we normally do in a basic trust structure. So holding property in that company means that you do get that tax advantage. But then it also means now the company is producing an income, which you can then use to service the loans. So I'll talk more about that in just a moment as well, because it's also important to note about the responsible lending legislation and the Consumer Credit Code. And to a certain degree, companies don't fall under the Consumer Credit Code because they are corporate entities. So again, that also impacts the servicing side of things as well. So yeah, that's the basic structure with the company from a tax planning point of view, especially with profits. Everything stays in the company. There is one problem though with companies, and that is when you want to sell the property within a corporate entity. So companies do not get the CGT tax exemption, and unfortunately, property is considered passive income streams. So whilst there is a small business tax offset for entities that earn less than a couple $1 million, it does not apply to residential property when you sell
Right.
the property. However, and this, I guess, is where a little bit of creative lawyering and tax planning comes into it, you could potentially save your CGT discount if you were to dispose of the company that holds the property, not the property itself. And so what I mean by that is if you have one company that owns one property and you were to sell the company that holds that property to another person who wants to buy the business or the company, then as a shareholder, the profits made on the transfer of the shares, which will be at market value, and so market value of the property, you will still get your 50% CGT discount if the company has held that property for more than 12 months. So you can still get it. It's just limiting who you can sell the company to, right? And so I'd love to say this to real estate agents out there. If there's any agents who are investor focused and, are willing to, buy and sell corporate entities with properties in them, then this could be an interesting avenue, right? But like I said, it's very, very rare that that happens, right? And so this is why we kind of look at then the trust structure, so to speak, which isn't really a structure, it's more of a contract,
Right.
right? So how trusts then work is basically you have a couple parties. The first one, or the most essential one, is the trustee. Now, that trustee can either be an individual or a company, right? And then you have your beneficiaries, who are the people who are going to benefit from them. And depending on the type of trust, and we've got different types in Australia. So we've got our basic, fixed unit trust, we got our discretionary trust, and we have hybrid trusts as the three main broad categories of trusts. But ideally, like, depends, that will determine, the type of trust determines, I guess, how those beneficiaries will benefit. So if it's fixed unit trust, it's a bit like a company. Shareholders, it's based on proportion. So if you have a husband and wife, ideally they will be 50-50 as the beneficiaries, and that's fixed. So their distributions will always be 50-50. But in a discretionary trust, as the name suggests, the distributions are going to be discretionary. And that's why a lot of people love discretionary trusts, particularly from a tax planning point of view, because you can distribute to mum and dad, you can distribute to your kids when they turn 18 and they're at uni and don't have jobs. So you can, filter, I guess, the profits made from the properties down to, whoever earns the least amount of money as possible from a tax planning point of view.
Right.
Um, so what's really important about setting up a trust structure is that trustee, right? So if I were to set up a trust and have me personally as the trustee, then I'm going to have the same problems as buying property in my personal name. I'm going to hit that beaker when it gets filled up and can't service the loan anymore. With having a company as a trustee, and this is where it gets really, really interesting, the entity itself has its own servicing limits. And what I mean by that is, and you might be thinking, well, how is this possible? I've just set up a company. It's not making money. How is it going to service a loan? Well, congratulations. You've now become, as a director of the company, effectively become the bank of mum and dad. So you guarantor the loan for the company. So you're still using your service ability, but in capacity as a guarantor. And this is where understanding the banking legislation and lending legislation is important, because from a servicing point of view, guarantors, yes, it will show up on your servicing checks, but it doesn't necessarily say the amount that you've guarantored the property for, right? And you're not the name that's on the loan documents either. It is the entity itself. So how this then works with either companies or companies that have that corporate trust entity is that you as a director will guarantor the company to take out that loan. And so that loan then stays only with that entity. So if I go to another company, then the same process happens again, right? Of course, the bank will know that you have guarantored an entity, right? And they will often ask the question, well, can we please see the financials of that business? And this is where it is important to show that at least the debt obligations are being met. And that's where we then also work with an accountant to provide the right documentation and the financials back to the bank to demonstrate that the company is managing the asset on its own effectively, right? And if you do that, then you can kind of go company one, company new, company three, company four. And of course, you will pair that company ideally with a discretionary trust for tax planning purposes to distribute income. And of course, for the CGT discount, right? Because as I said before, even though we could probably save that with a company, how often do you see people selling properties in company structures? I haven't yet, unless it's commercial property, and that's a different kettle of fish. But for residential property, no one seems to do it,
Right.
right? So that's the basic structures, I think. Yeah. So is there anything there that
Yeah.
doesn't make sense, PK, or is there anything
No, I think it'll
should
be a
dumb
lot.
down?
It'll be a lot to take in for sure for some people. So I might try to. Actually, there's one thing that way back, you were talking about inheritance, and making sure whatever option you're going with is congruent with being able to hand it down. Because so many property investors, of course, they want to build wealth, they want to build passive income, but they want to build intergenerational assets that they hand down to kids, grandkids. So of course, none of this is financial advice and everyone's different. Um, but did I hear you correctly when you said that when you buy under your personal name and then there's an inheritance event, let's say, that the people receiving that inheritance or those properties, they have to pay like stamp duty or capital gains tax or how does
Yeah,
that
so
all
it
work?
depends. It depends, right? It depends on whether the person has a will or doesn't have a will to start off with.
Hmm.
So this is where estate planning comes into it. And it depends if you're passing it down to, say, children, then you probably won't have to pay stamp duty. But if you pass it on to, say, a best friend, then the implications from a taxing point of view changes yet again. So, and I say this with to anyone who owns property, you need to also have a will in place as well that can deal with those assets. But yeah, that's something that's really, really important to understand. And likewise with companies and trusts, right? Companies are perpetual. They don't have an expiry date. If I die tomorrow, someone will take over as director and my shareholdings will go to whoever I've gifted it to in my will. So the property can keep going and I can pass it down like that. Um, for properties in a trust, and even with a corporate entity, effectively, yes, that is the same. But most states, except for South Australia, limit trust to 80 years. So if you die and you pass it down to your kids might only have another 30 or 40 years left to keep that property in the trust before they then have to actually distribute that property. And then that can also trigger certain CGT tax events if certain requirements aren't met. So these are the conversations that you really need to be having with both your accountant and solicitor right at the very beginning. Because if you don't get the structure right, to restructure later means you're going to trigger stamp duty and CGT again, potentially.
Yeah,
Depends how the structure is. So, those are the considerations there. Yeah.
right. So South Australia was 80, is it 80 years for trusts? Are the other states and territories like a little bit more, or do you know them off the top of
No,
your head?
so like New South Wales, Queensland, Victoria, so all the states are capped at 80. South
Okay,
Australia has put what's called perpetual limitations, but, and this is where I would say approach this with a bit of caution, um, it hasn't been tested before the courts whether that will hold up,
right.
right?
Mm.
So whilst it might be perpetual, the law, like the common law of trust, says that trusts need to vest at a particular point in time. So how that then interplays with, the traditional law themes hasn't been before a Supreme Court in South Australia. It hasn't been even before the High Court in Australia yet. So it might be the case where someone's like, yes, I want to have this perpetual trust, and we won't probably see it for another 50, 60 years.
Mhm.
And realize, well, it's not really perpetual. It's just until the original person who set up the trust or the original trustee kind of, you know, dies out or passes it down to the next generation, but maybe won't go to the third generation. So we just don't know that how that will play out just yet. Um, so again, word of caution there. Yeah,
Sure, sure. No, I think it's worth everyone getting individual advice from their own accountants and solicitors on this. But it's a very, I mean, by hopefully watching or listening to episodes like this, you kind of figure out all the stuff that you didn't know, and like it can, like even listening to you, even though I kind of know much of this stuff, it's still very overwhelming, and it's like, oh my God, like there's so much to
yeah.
consider.
Yeah, and even from my point of view as well, like I have clients that come to me with some questions and I have to really think about these things because it is a very complex area of the law. And so I often see people on, Facebook forums saying, oh, buy and trust. And it's like, well, hang on a second. Yes, you got the CGT discount, you got the tax distribution, that's all good. But is it necessarily the best structure for your personal investment strategy?
Hmm.
Right. So it might be good if you're going to, buy, flip, buy, sell, etc. If you're buying and hold, you don't really need to have a trust. You can just leave it in a company because it's so much easier to manage the asset if it is in a company and pass it down. There's less complexities around that. But then you also have your land tax considerations as well, right? And
Sure.
this varies state to state. So CGT is a federal tax, so it's the same across every state. Stamp duty and land tax differs from state to state, and land tax and structuring is very, very important. So, for instance, in New South Wales, would you use a discretionary trust to own property? Probably not, because from a land tax point of view, you are paying land tax from $0 or from the first dollar that the property is valued at. And so if you are a savvy investor, I mean, look, you can factor that into your planning as well, and it's definitely something to factor in. But at the same time, there's only so much you can charge someone for rent, and if you're going to start paying an additional $5,000 a year on land tax or more, then that's an extra $100 a week you're going to be charging to a tenant to cover that. So you got to weigh that up and then weigh that up with the potential CGT benefit if and when you sell. So again, like when you are thinking about these structures, you also have to think about the bigger picture and what is your investment plan.
Mm.
If your goal is just to kind of, flip and have capital gains every couple years and pay some CGT, then happy days. Use a discretionary trust, that's fine, or use a unit trust in New South Wales as well, because the unit trust in New South Wales has the individual tax threshold, but the discretionary trust doesn't. So these are considerations to think about.
So just to be clear, sorry to interject, in each state, the land tax free threshold is different for a unit trust versus a discretionary trust versus a company versus personal name. That's what you're saying. I just want to
Yes,
make sure it's
yes,
clear for
yes.
everyone.
So I'll just use New South Wales as an example because that's the state I'm based in, right? So let's say, don't quote me on this, this is not the correct figure, but let's say the land tax threshold in New South Wales is at $1 million. Okay. That threshold is in your individual capacity. Companies also can hold property value of, say, up to $1 million. And so can fixed unit trusts. However, discretionary trusts don't get that benefit because in New South Wales, they say, well, we don't really know who you're going to distribute to. That person might own other property. So we're just going to tax you on the value from the first dollar, right?
Mhm.
Victoria is again similar, but different thresholds. So for instance, I think the threshold in Victoria for personal land tax has dropped down to 100,000, but for trusts, it's 50,000. And that's regardless of whether it's a fixed trust or fixed unit trust or a discretionary trust, it's just at 50,000. But then there are exemptions for rooming houses, for instance, that don't have land tax or won't pay land tax. And then we look at Queensland, where it doesn't matter if you buy in a company, personal name, discretionary trust. Oh, sorry, personal name is a little bit higher, the threshold, I should say. But like for companies and discretionary trusts or unit trusts, it's a fixed threshold of, or I think it's 350,000,
Yeah.
right?
Yeah.
Then we go to WA, and it doesn't matter what structure you buy in, because nobody pays land tax in WA. So, so these are the things you have to be thinking about. And South Australia is very similar to Melbourne, and with the threshold limits. So you have to, and it's hard because you don't have that, foresight necessarily at the beginning.
Yeah.
Saying, am I going to buy and hold? Am I going to sell? But like, for instance, for people that I know who are keen on buying and holding, like if they're buying in New South Wales, I probably wouldn't recommend a discretionary trust as my go-to strategy to begin with. I would look
Okay.
at other options first. And even that, I've had a client in Victoria who wanted to buy a property but hold it for 10 or 15 years. And we sat down with their accountant and we did some forecasting as to, how much land tax will you be paying over 15 years versus how much would you potentially have to pay on tax with your capital gains. And after that 15-year period, the difference was, I think, probably about $5,000 difference. So it was still better for them to pay the land tax every year to save 5 grand at the end of the day. Um, but again, everybody has different circumstances, and that's why you need to really work together with your accountant and also have your solicitor to set up those documents to your correct intentions.
Yeah, yeah, and it's just so useful because, and also I don't want people thinking, oh, land tax is really high in New South Wales, therefore I'm not going to invest in New South Wales, I'm only going to invest in Queensland. I remember when I first started, I was tempted just to buy in Queensland because I was thinking that the stamp duty is much lower in Queensland versus most other states. So I was like, I'm going to hack the system. But at the end of the day, there's no perfect state. I mean, Queensland's probably as close, but then WA doesn't have land tax. So there's no
Yeah.
perfect outcome, and same with structuring or choosing which ownership model you want to buy your properties. And there is no perfect solution. And so, like us saying you really do need to customize it is not like a cop out, or it's like it's actually the truth. And I think one thing that is quite difficult for the novice investor, Monica, is like when you go to three different accountants, or I'm just making this up, three different solicitors or tax lawyers, you sometimes tend to get like conflicting advice. Like I get people messaging me all the time saying, "Oh, I watched your video the other day, PK, on how to get endless borrowing capacity through a trust structure." And I went to my accountant and he said that was a scam. And so I then went to another accountant. He said, "Yeah, I've helped more than 100 clients do that." So it's
Yeah.
like, who do I trust? I don't know if this is a question to you per se, but like, what's your perspective on that?
It's funny you say this because I actually teach business and corporations law to accountants in one of the universities that I'm at. And believe it or not, I mean, look, accountants, particularly those that have the chartered accountancy qualification, probably are better at understanding structures than someone who just has a CPA to begin with. Um, so there are, I guess there's different levels of accountants, and likewise there are different levels of solicitors. So I have friends that are solicitors who have never studied, the intricacies of trusts and corporations because that's not their area of law. They don't know this stuff. And when you speak to them about it, they're like, wow, and they feel, overwhelmed as well. And they're like, how
Right.
come I never picked up on that? The reason why I did this is my area of law that really interested me. I did work for a tax accounting firm, so I do have a background in indirect taxes, and I also got to see exactly what these uber wealthy clients were doing to structure their assets. And that is when I realized, well, none of these super rich people have, property in their personal names. And so you have to ask yourself why. And so through my connections and that's kind of and my training, that's where I learned about these structures. So a lot of it really depends on the experience of the professional. Your typical tax accountant is not necessarily going to know how to structure assets because that's not what they do. They're very good at bringing down your, taxable income so you pay less tax. And funny, just on that point, I learned also the hard way of probably if you're looking to buy property in the next 12 months, you might not want to be paying as little tax as
Yeah.
possible at tax time. So I know that's around the corner. Like you want to have more taxable income because that's going to help you service better. So little things like that. And so a lot of accountants are very much on like, let's claim everything, claim everything because you get money back. Well, um, for property, you don't really want to be getting money back because those small gains is not going to be enough for you to have cash to buy property, particularly at the rate the market is moving. So, yeah, like I said, it's really just the experience of the professional, the more professionals that deal in these areas, and those are the questions you should be asking your accountants and your solicitors is like, have you had clients that have done this before? If they say no, okay, see ya, bye. Like, go find someone who says, yes, I have clients that do it. Because they will be able to give you that advice. If they've not done it before, then they're limited by their own knowledge and experience.
Yeah, no, well said. And I think it's so tempting as well. I think people have FOMO because I just got the stats just this morning, and in May, which
Yeah.
is previous month, we're recording this in June. In May, the property market or the national average went up 0.8%. And so if you annualize that, that's almost double digit gains. And so people are like, by the time I ask like accountants and solicitors, like I've missed out on like 20, 30, $40,000 of growth. But honestly, I think you need to step back and see things strategically, because if you get the wrong structure or the wrong setup, then forget that $40,000 of growth. You might be costing yourselves 500K in unnecessary taxes in a transfer event 20 years down the line or 30 years down the line. So yeah, I think just chill and let the growth happen and just get that strategy real solid to start with.
Yeah, absolutely. And that was the thing for me when I had to restructure my own portfolio. I had to pay CGT and stamp duty again. And it was not cheap, right?
Mm.
And luckily I had like the equity in a property to do that, but that was a deposit for another purchase that I could have, done, but I had to use that money first to fix my structure up to be able to have that endless borrowing capacity, or what I call the ability to debt silo, so you can have that endless borrowing capacity. Um,
Yeah,
so yeah, that's I guess the thing to think about as well. One other thing I probably should also mention with purchasing properties in these various entities, corporate entities, or so either companies or companies with a trust of some sort, is that there are more complexities as well from the lending point of view. So because you are guarantoring the loan, you now have to get independent legal advice for most banks for that to process that loan. So again, that's another cost you do have to factor in. And of course, the cost for setting up the structures as well, which is often, if it's a company with a trust, you're looking about close to 1,000 or just over $1,000 every single time you set it up.
right. And with these siloed borrowing entities to kind of unlock the endless borrowing capacity, if we want to use those terms, if you buy in a company structure every time versus buy in a discretionary trust structure every time with the corporate trustee, does it matter in terms of the fundamentals of the endless borrowing capacity, that sort of siloed borrowing model that we're talking about, whether it's bought in company versus discretionary trust with corporate trustee? Is
No,
it
no,
much the same?
it's the same thing, because at the end of the day, it's the company that is giving the benefit. So whether it's a company in its own capacity or as a trustee, it's the company that gives that benefit. The only thing you have to be aware of is you do have to have deposits, and your entities need to be able to repay those loans fully. So if you are thinking to negatively gear in a company or a trust, well, first of all, there's no such thing as negative gearing in those entities. It's just essentially running the business as a loss. And those losses, yes, they can be rolled over to future income years, but that will then, if the property is running at a loss, then that will impact your servicing on the next loan, on your next facility. So you just have to factor that in. And of course, that's also dependent on certain lenders, right?
Right.
Yes. So
Right.
for the tier one lenders, yes, it definitely impacts it. For the tier two and of course tier three lenders, they probably don't care. But yeah, like it is something you want to try and, aim towards, is making sure that the loan can pay itself off so you are not negatively geared in those entities. Um,
Right.
yeah.
I'm just mindful of time, but I know you have to probably go soon. Just a quick last two questions. I don't want to be a party pooper, but I think people will be thinking about this, with rates the way they are. They're not super high, but they're high relative to the last sort of 5 years. And almost no properties are, of course, positively geared from day dot, especially at, let's say, 80, 88% LVR. Of course, give it 2 years, rents go up, maybe rates come down a notch, then they become positively geared. But right now, they're not. Um, does that mean this whole endless borrowing strategy kind of falls on its face because none of those companies are actually self-sufficient?
Yes and no. So a lot of it is to do with a waiting game, but there are other things you can potentially do to have the endless servicing or the endless borrowing capacity. So one of the things is, if you have savings, put those savings on your, offset account, right? Because then suddenly that entity is going to start performing positively, right? So there's ways you can structure it. Likewise, I mean, depending how you put the money into the structure, and again, this is not legal or financial advice, um, remember that it is a corporate entity. So you could effectively charge someone a consulting fee, i.e., yourself, to pay money into the company to then offset that, deficit as well. So there are creative ways that you can do to kind of circumvent that. Um, but yeah, the easiest one is just any savings you have, transfer it onto, the offsets of those facilities. Yeah, that's the main thing. So yeah, you just have to you know, talk to the right people and come up with a strategy. But even that, as you said, and I've known this with my own properties in the last couple of years, if for whatever reason they're not going to be performing as well as they should, I just wait 12, 18 months and then I can go again. And then I also have equity as well. So
Yeah.
it's kind of like a win-win in that regards. Like I think a lot of people think property is a fast game, particularly if you have had a lot of equity growth in the last couple of years because of COVID and other economic factors. But, you know, um, the people that I have seen that have 40, 50 properties that are making $1 million plus a year from property have done it over 20, 30 years.
Yeah.
So it is a slow game. I think a lot of people are very lucky if they own property just before COVID and have had that growth, that then probably may be able to expand that portfolio, at least initially, a lot faster than what we traditionally have been able to do so. Great, by all means take advantage of that, but structure it the right way because then once you've bought those properties, you will see a bit of slowdown.
Right. Right.
But having those structures in place will just, allow you to do things tenfold,
Great
basically.
advice. Great advice. And so practically, like, of course, you're a solicitor, so you're on the legal side of things. Let's say I'm a normal mom and dad investor. I hear all this and I'm like, yeah, this sounds great. Kind of goes over my head to some extent. I need some advice. Should I be going to my accountant first and then sort of asking them to get in touch with a Monica type person, or should I be going to Monica first and then she or you will then
Yeah.
liaise with an accountant? How does it work?
Yeah. So usually what we tend to do is say to clients, what is your strategy? Number one, figure that out, whether they figure it out on themselves or they speak to some sort of financial advisor or property strategist out there to figure out, are they going to be buying and selling, buying and holding? How many properties do they want? Because I mean, I know for me, for instance, when I first started buying property, I didn't have a figure in mind. I was just like, yeah, I'm just going to buy one and see where it takes me, right? If I had said to my accountant, and he says this to me, he said, oh, if you told me you were thinking to buy 10, 20 properties and live off the income from those properties, I probably would have told you to structure it, years ago when you were, in your early 20s before you had studied law and all this other stuff. Okay, fine.
Hmm.
Um, so again, this is what I mean. Like sometimes accountants might know these things, but they just don't think unless you tell them your goals, they're not going to give you that advice to begin with.
Yeah.
So I would
Yeah.
say figure out the strategy first, and then structure the entity. And look, you can have a conversation with your accountant in between if it is your typical accountant and say, look, I'm thinking to do this. What are your thoughts?
Hmm.
But then go and get the advice from someone like myself or a solicitor who can actually give you the ins and outs of the legalities behind why you're structuring it that way. And what I do with my clients as well is I do, sessions, sometimes hour or 2 hours with them where we actually, draw things out and draw them these diagrams of how these structures are like.
Yeah.
And talk them through, what you can then later do with these structures, which I haven't talked about in this video,
Yeah.
particularly with lending between entities, and that's where it gets really really cool and interesting as well from a tax planning point of view. So we do guide clients through all of this first, and then we say to them, okay, now that you've structured, now you're ready to go and buy some property, go off and buy some property, and once you have that property bought, that's when you go back to the accountant for tax planning purposes, and to you know yeah, get those accounting letters for the next purchase and
Got
so
it.
forth.
Got it. It's really good to know, and I think that strategy part is so important. At least for my clients, we shouldn't just have like I want to make 100K passive income in 10 years, some sort of arbitrary goal. But at least for
Yeah.
my clients, we reverse engineer that and say, based on your capability and capacity and your goal, here's a financial model. Let's reverse engineer and see what's actually possible, and then go to the solicitor, go to the accountant, to actually make it happen. But I'm so lucky my wife is a CA, so she she's across this. Monica,
Yeah.
how can people sort of find out about you? How can they reach out to you? How can they get
Yeah.
in touch?
So easiest way, and I might just give you my email afterwards as well. But if you contacted me at monica.r@soundcouncil.world, so that's my work email address. Otherwise, search for me on Google or follow me on Instagram and Facebook. So just on Instagram, I'm at Monica Revelis, so very easy to find me.
Yeah.
And just send me a DM and we'll get in touch and go from there.
That's awesome. That's awesome. Well, thank you so much. And guys, I must stress this, and I'm not sort of like trying to give Monica business or anyone business here, but I think it's really important when you find a professional, don't just like, pick their brains for 2 hours and expect it for free. Like if you seek advice, be prepared to like invest in that advice. Do you know what I mean? So, a lot of people complain, oh, I'm trying to figure out this endless borrowing capacity structure, but I can't get 2 hours with my accountant or an hour with my accountant. Like, if you want good professional advice from good professionals, the price is what you pay, value is what you get. So that's very important. Shout out to for whichever professional you're using, whether it's Monica or not. But thank you so much, Monica. I think that was a world of of not advice but information. Hopefully, we have to watch that maybe 2 or 3 times to really absorb it. I'm very grateful and thank you so much.
No worries. Thanks for being here.
And thank you everyone for watching or listening. If you did find it valuable, please let us know in the comments your thoughts as well. I did a video just last week with a mortgage broker on a similar kind of vein on endless borrowing capacity. So maybe match the two up, build your knowledge, invest in yourself, and don't have FOMO for the real estate market, even though it's going up. Set your strategy right. You'll thank yourself in the future for it. Thank you for watching. Hit the subscribe button, hit the like button, and thank you again, Monica.